Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Friday, June 28th, 5:16 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the second quarter wrap-up edition of the Revere Roundup Daily Market Insight video. End of June. We love it when a month and a quarter ends on a Friday. Very symmetrical. Lets us do our quarter end work over the weekend and get ready for July. The first 2 weeks of July are historically two of the strongest weeks of the year in the market. After that, things uh, look worse. But again, this is seasonality, which is a secondary indicator. We take our cues from what's going on with the price and volume of the major indexes and the leading stocks and leading sectors. We are aware of seasonality, but we'll see what July brings us. Abbreviated week next week with the 4th of July holiday. So, state of the market. We are in an uptrend since May 6th, so almost 2 months now. Check the trend gauge. We've got the coveted four green arrows, market leaders acting fine. We got at least four coming off of this week's 21 over 21 list. So some subtle weakness. Got the yellow sub arrow there, but there are more than enough candidates getting ready to claim those four spots in the coveted 21 over 21 leaders list. And as far as the five major indexes go, we've got only the mid caps now below the short term 21 and medium term 50-day moving average, as small caps reclaimed it today with some strength into the close. Quarter end shenanigans, rebalancing. Hard to trust anything that happened in the last half hour of the market. But we do have strength from the NASDAQ 100 and S&P 500, as well as the Dow Jones, all above all all three of the timeframes that we track, and all five indexes above the 200-day moving average. The market never gets into serious trouble unless we break that long-term 200-day moving average. So what happened today? We've been talking all week about this 7-day height range that we were in, looking for a catalyst to break out. And then if we did break out, would the breakout stick, or would it be a failed breakout? We got a little bit of everything today, and factor in quarter end and rebalancing. And there was definitely something for everybody there. So first of all, before the open, PCE inflation data came out, and that was in line. 10 o'clock Eastern Time, consumer sentiment from the University of Michigan came out, and that has the potential to move the markets, and it came in higher than expected. The markets after the open, well, first of all, wake up in the morning, and the markets are green after they started rallying during the debate last night, stayed green overnight. PCE spiked them a little bit higher, and then they started to pull back near the open, opened up about 0.1% higher, but small caps opened up 0.8% higher. And we worked our way higher the first 30 minutes. That University of Michigan sentiment data hit. We made highs of the day. 45 minutes into the session, went sideways for about a half an hour, and then a 4.5 hour sell-off, three waves down in the indexes and carrying over to leading stocks, but not all leading stocks. Some very clearly um, showing relative strength during the day. I'm looking at you, Uber. We added to our Uber position today. Also, TMDX showing strength all day as well. So there were pockets of strength. Leaders about split, maybe a little more to the downside. But small caps, as I mentioned, did reclaim and stay above the 21-day moving average after gapping above it and then selling off hard. And that sell-off and reversal at 10:15 coincided with rates ticking up, which was a little bit of a surprise because rates initially were down after the PCE data, but they started rising around 10:45 a.m. Eastern time. That coincided with a reversal in the market, the three waves down, and then some real wild action the last 30 minutes in individual names and in the indexes. But here's the bottom line on the day. Our 21 over 21 leaders list split 8 up, 12 down, 1 neutral, down an average of 0.20%. The big eight, this is where the weakness was today. These have been the strongest stocks all week, not today. 7 out of 8 down, and down an average of 1.44%. The RG8, our 8 growth ETF composite, we've got 4 of these looking pretty good, 4 of these looking so-so to weak. So it's a bit of a mixed bag there, and I'm talking about their pattern formation and the stochastics. But today, down an average of 0.12%. The S&P 500, after being up about 0.6%, hard 3 waves down as much as a 0.5% before closing the gap a bit, but still down. Big shakeout today at 330, and then a hard move up, and then it was reversed. Crazy action. We'll look at it on the 5-minute chart here momentarily, but the S&P 500 down 0.4%, equal weight, slightly positive on the day by 0.07. NASDAQ 100 down 0.5%, equal weight down 0.20%. The Dow down 0.12. Bright spot on the day were mid caps and small caps. Mid caps up 0.25%. Russell 2000 up about 0.5%. Was up as much as 1.5% early in the day. So, and then went red and then rallied. Global 60/40 stock and bond down 0.25%. As I mentioned, rates initially down on that PCE data and then spiked. Our flagship GROTECTION portfolio up as much as 0.7%, but it reversed along with the market, ended up down 0.5% on the day. Let's dive into the charts now. And let me get rid of the trend gauge because we want to show, since it's the end of the week, we want to be able to see the charts of both the weekly and the daily chart. And you can see here the breakout above the 5,500 level. Let's go and check out that wild action, first of all, on the 5-minute chart here in the S&P 500. So here's the mild gap up, strong move up higher. Then at 10 o'clock, that consumer confidence came out and a big squeeze higher, all-time high, 55.23, everything looking great. We go sideways for about 30 minutes and then a big 3 waves down, culminating with this wild candle at about 3:30 to 3:35 Eastern time. That was a shakeout. We rallied from there, sold off a bit into the close. So let's get some perspective from the 30-minute chart here. And let's draw a couple of lines. You're aware of this move up and then the 7-day consolidation that we've been talking about. 54.91 to the upside, 54.47-ish to the downside. One failed breakout here back on 620, just bouncing around in a tight range since then. Here's your another failed breakout this morning and a harsh sell-off. But where did the sell-off stop? Stopped at the bottom of this range here, 54, this 54.47, tight range, bottom of the range that we've been talking about. So we bounced off there, and we'll see what next week brings. Now, obviously, very key. From failed moves come fast moves. We are prepared for it. It happened back here on the 20th. All we ended up doing is going sideways for a while. It happened again today, a little bit more harsh, no question, because we made a higher high and a higher low relative to that last shakeout day. But until we start breaking below this 54.47 level, and then by 2 other levels down, you've got the 54.05-ish level, where we initially gapped up on the 12th, went sideways for 4 days before breaking out to the higher range. So that's another consolidation area that should provide some support as we come down there. And then you've got a gap to fill. Gaps fill typically very quickly if they're going to fill. So if we come down to here, 53.75-ish is the level that we're looking at. Really 3 fairly same-sized ranges that we're talking about. But things get dicey if you get down here in this 53.60-ish area, where that would mean that the entire breakout failed from June 12th. So if you go back to the daily, here's our June 12th breakout. Let me just confirm that. And no, that is the June 5th breakout. Here was the gap up. So another level a bit lower than there. Now, we do have the 21-day moving average coming up to the bottom of this prior range. It's filled the gap now, so that should provide some support, keeping us from going down to this prior range where we did the breakout on the 12th. Go back to the 30-minute. Here is the June 5th gap up. You can see that on a 60-minute. The 6th right here, the move higher. This was really a kind of a declining tops trend line that we faked out above, went back into, and then again at that 5,300 level, and then you've got this support level, the gap to fill, the 54.47-ish. And as you come down through these, will this just get taken out of the market? All corrections start by a mild correction. First, you break the 8 EMA. We've been holding that. We closed right on that today. Then you break the 21. Then you break the 50. Below that is the 100-day moving average, and that's exactly where we found support last time we were selling off. So it's very possible it could roll out. Maybe after the first 2 weeks in July, we go sideways for a bit for the first 2 weeks that are supposed to be strong. No guarantee, of course, there never is. But the setup was there for the breakout today, and it was news driven, and it failed. And that's somewhat of a disappointment, no doubt about it. So we'll put the brakes on further ads. We did a few this morning. We did one this afternoon when Uber continued to show extreme strength. It was just a good risk reward area. But we've got our stops in place. Our downside is between 4 and 5% until we would get completely taken out by our stops, or we would start hedging because we would be into this big range here. You've got the 100-day moving average, the 150-day moving average, and we just play it light, absolutely below the 50-day moving average, because this is where it's just a industry standard almost, you could say. Some people don't believe in technical analysis, but it's real. Stocks and indexes react to it, and we're included in there. And it's just frankly a sign of a trend. When you've got moving averages trending higher and price above it, it means the trend is strong. Ride the wave just the same way we did back here from November to March before we started to correct. And this is another wave that we're on, and we'll ride it until it reverses as well. So that's a long-winded explanation on a failed breakout today. It doesn't mean the world is ending very clearly, but it's disappointing if you're a bull. But one level at a time, and that next level down is 54.47 that we need to hold. And then if that fails, we get into the next level, then the gap fill, and then this breakout here. So one level at a time, one day at a time. You keep your stops in place, you set them, you monitor your open heat, and that gives you the confidence not to panic if you know what your downside is. And that's one of the best lessons that I could teach, is to know how much you would lose to the downside if all your stops were in place. Be comfortable with that. Don't overtrade. Don't suffer 1,000 cuts when you don't need to. And set your sizes, do pyramiding, and reasonable stops, not tight stops. Understand what the average true range is on whatever it is you're trading, and take it one day at a time. Try to take the emotions out of it and make it be data driven. So there's the S&P 500. Next up is the NASDAQ 100. This had been stronger, but this just came up to the top of the range. So not really a breakout, just right up to the two prior tops and reversing down, closing right on the 8-day moving average. So very clearly you can see the relative strength we've been displaying there. Relative weakness last week, so this week, but hard reversal. Big strength out of the big 8 for the first 4 days of the week. Not so much today, but they did just get a bit extended. We've got a few of them in our portfolio. They've been acting well. And add on to that the NVIDIA post split and reaction. And it just NVIDIA just went a little too far too fast, and now it's correcting too, but holding the 21-day moving average. We'll take a look at that chart momentarily. But there's your NASDAQ 100 in the range we're taking a look at here. You can also see that has the same gap as the S&P 500 did, and the 21-day moving average is up to the top of that gap now. So that's the first level that we're monitoring should it come lower. Next up is the Dow Jones Industrial Average. And long candle today bounced at the 21, closed in the bottom third of the range. It looks okay. Relatively speaking, it does not look okay. But if you look at the chart itself, it looks okay. It's just been playing ping pong between the 38,000 and the 40,000 level. Now on to mid caps. Mid caps have made, you can see from these spikes, several attempts at rallies, at another one today that got above the 21 and the 50 and failed. So we're continuing to make lower highs, but also making some higher lows. And this will come to a point at some point, it'll either break out of this triangle that's being formed, or it will break lower. Very clearly, relative strength has been an issue, but now the relative strength line is at least keeping pace on a net basis with the S&P 500, although not necessarily on an everyday basis. Now let's go to the Russell 2000, as this also has been in a channel, a rising channel recently over the last 2 weeks, making higher highs and higher lows. And you can see the relative strength very clearly stopped going down. If you zoom out a little bit, we were looking at this level, not connecting the exact tops. When something gaps up and it stays there for 5 minutes, you really don't need to draw a line and connect it the top of there. We're really trying to come up with, generally speaking, what happens. There's also 2,000 stocks in here. It's very interest rate dependent. It's very sector dependent. But on a longer time frame, we've got a descending channel. On a shorter time frame, we've got an ascending channel, meaning higher highs and higher lows. And that break above the double moving averages today, we took a dip into UWM. That is a 2 times Russell 2000. It reversed as well, but look at this. So there's the gap up, and then there's the sell off during the day. There's also the shakeout. But whereas on the S&P 500, you went up and then back down, this just continued higher. Now, again, may not mean a darn thing because of quarter end and rebalancing, but at least we did have a positive close mid-range and a close above those key moving averages. 50-day is trying to turn up, 21-day is about flat, and we'll just trade against this level. Took starter position 2%. That's the equivalent of 4% in the IWM. Watch how we monitor a pullback. Today's low is critical, and then right under there you've got the 8-day exponential moving average, which will come up through the 21 next week. And then we just play it against various levels and see if we can get a strong trend. We know when this trends, it can go a long way in a short period of time. The catalyst initially to us was the drop in interest rates on PCE this morning. That's why we took the entry. But as interest rates came off, this came off as well. But it did have the decent close. Banks were extremely strong today. That was what really buoyed the Russell 2000 up. Let's look very quickly at the equal weight of the indexes. Here's the S&P 500 equal weight, still in a very tight range here, not a breakout by any stretch of the imagination, the way we did with the market cap weighted indexes, but just going sideways and relatively weak. Relative weakness, it goes back and forth with this. You know, sometimes it's down, sometimes it's sideways. There's been times when equal weight strongly outperformed. And we're always on the march looking for that. And one of the ways that we monitor it is the 21-day moving average of the relative strength line. We are always keeping an eye on that. You can see how it's been below there. You can apply moving averages to relative strength lines the same way you can to the price lines. And really what you want to see is this get back above the 21-day moving average to indicate that equal weight is outperforming market cap weighted. So that's the RSP, QQEW. I know a lot of people use QQQE. They look basically exactly the same. QQQE trades a little bit thicker, but got to the top of this handle and reversed today. Still relatively weak versus the market cap. Again, we're monitoring this to see if it can get above the relative strength 21-day moving average line, as well as stay above the 21-day moving average on the price chart and break out. So those are the major indexes. Let's go to the VIX. The VIX continues to contract. We're down to a 0.8% range on the S&P 500 and down near this 12 level. We have had spikes when we come into the 12 level. We had one last week. We'll see what happens next week, but this is indicating a lack of volatility and a tighter daily range, and that is what we're seeing. So there's the VIX. Let's go to the dollar. Dollar traded. That is not a good chart for the dollar at all. I'm not sure what's going on with that. I do have, all right, we got a bad tick is what we have with that. So we're not going to be able to look at that. Let's look at UUP. The dollar in an uptrend after breaking out of this sideways move. That doesn't help individual names. Let's go to precious metals, GLD. These gapped up today, held the gap for the most part, but didn't make any progress. Gold flat, GDX gapped up briefly above the 50 and 21 day, but reversed along with the market, down 0.9%. And silver. Silver also got above the 50-day, ran into the declining 21-day, so it's between moving averages there. On to Bitcoin, which continues to look terrible relative to the moving averages, but is really just down to a massive, pulling down near the bottom of this massive trading range that it's been in. Here's the breakout. The breakout is still intact, but it's given back basically all of it, and we're no longer in this. Now on to bonds. Let's look at a 5-minute chart of bonds here. You can see bond price gapping up. That means yield gapping down. And then it looks exactly like the market looks basically. And that is meaning yields would be doing the direct opposite. So yields gap down and work their way higher. And as they work their way higher, the market itself came off. So here's the broad bond index. You can see the wide range on the day, not a surprise considering the inflation data impacting. Here's the long bond, TLT, also a big range and big to the downside. And then the yield on the TYX down 1.24%. That is not right. I think we've got a problem with this range as well because the yield ended up higher on the day. And again, look at this big candle. That's causing a problem. That's a bad tick. That's probably going to show on TNX as well. Yes, it did. Okay. Yields were up. Trust me on that one. That's our inter-asset correlation. Let's go to the tail of the tape. And yields had to be up because the price of the bonds was down. So here's the tail of the tape. PCE inflation data, we talked about that. University and Michigan sentiment, we talked about that. So day count. We're still in an 8-day consolidation, but with a 1-day down and a failed breakout. This 54.47 to 54.91 range still intact. We got above it today, but couldn't stay above it. So it's the upper end of the range where a lot of trading has been performed. Above there, we just can't hold it, and we failed twice now. Talked about the intraday volatility. Let's talk about sectors. Oil's up today. Banks, transports, as FedEx had another good day. Semiconductors, software, financials, and real estate to the upside. Dollar flat to the downside. Solar has just, we talked a lot about this in the podcast today, have just completely fallen apart. And 3 sectors to the downside: communication services, utilities, and consumer discretionary. From a portfolio standpoint, bought Abercrombie and Fitch. We'll look at that chart in a minute. Bought UWM. We mentioned that. We sold GEV on a breakdown below the 21, and we added to Uber, which had extreme strength all day, even during the pullback. That raised our adjusted beta a bit from 1.46 to 1.53. This effectively means 53% more exposure to the market than the S&P, than an all S&P 500 portfolio. Bottom line on the day, PCE was okay. S&P 500 broke out, but failed miserably back into the base, while small caps finally had a close, at least a single close, above their 21 and 50-day moving averages. Now, let's take a look at some charts, and we're going to go to the 21 over 21, and we'll show what's going to be coming off for the week. So we've got these sorted by percent change on the day. We'll show the strength first. This is not the right file. This is the right file. Here we go. All right. Strength on the day. Uber. Look at this intraday on Uber. Even while the market was pulling back, this just held up like a champ. When you own this and you're monitoring it, you can tell when something is showing extreme relative strength, and this certainly did today. So we took our position size up to 5% on Uber today. Volume, not bad. Ended up average on the day, but it was very clearly strong all day. Next up, Abercrombie and Fitch. This was strong out of the gate today, regaining the 8-day and the 21-day moving average. So basically, declining tops trend line breakout was the reason for entering this. It was on our 21-21 list. You know, volume with the you can't necessarily take volume at face value today because of rebalancing in the end of the quarter. But where it is on the chart, you can embrace that 100%. And you can see the ANF breakout today. So added that to the portfolio. TMDX, all-time highs. COHR continues to hold up well. NRGU above that 500 level, or actually right at that 500 level. And Kava with a positive close today as well. On the negative side, First Solar, this is obviously coming off the 21-21 list with a very clear break below the 21 and the 50-day moving average, down 9.8%. And if ever there's a reason to use stops to lock in gains, this is a poster child for it. ELF, after a big day yesterday, inside day today, but down 3.3%. See, this is just artificial. Look at that volume because of end of quarter. Meta, hard reversal the last couple of minutes. Look at this. This is end of quarter shenanigans. So Meta down. GEV stopped on this today. Approached back near the 21-day moving average, but we did stop out early in the day, and with the close below, it'll come off the list and go to our universe list, as it is still a healthy stock in a good group. Amazon, weekday today after 3 out of 5 very strong days. Dutch Brothers continues to act well. HIMS is going to come off the list as well, with multiple closes below with the big gap down. Yesterday, there was a short seller that put out a report on HIMS about their GLP-1 compounding weight loss shots, and the market sold off and it broke below the 21. That'll come off the list as well. Micron, which we bought after earnings, down near support, hasn't made any progress. It's basically down 50 cents from where we bought it. So it's below the 21, still above the 50-day. This is a very small starter position. We'll give it a little bit of room with it being above the 50-day, but we got one foot out the door on this, and this will come off of the list as well. So those 4 will be coming off the list. We'll complete the list on Monday with the next video. And that's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. I'm on Twitter at Vandenbord. The phone is 855-REAL-WEALTH. That's 855-732-5932. Our flagship portfolio. Already mentioned this, but I'll say it again, because it's not how much you make in the market, it's how much of that you can keep. It has a dual mandate: grow assets during uptrends, following the trend of the major indexes and leading stocks and leading sectors. Tap the brake a little bit when we start to pull back. Depending on how harsh that pullback is, we could be completely out of the market or fully hedged, like we were in 2022, missing this. We lost money on the year, but significantly less than the overall index did. And we dodged this pullback too, which broke the 200-day moving average. This ended up being no big deal. When you break the 200, you don't know how low you're going to go. Much lower in 2022, much lower during COVID, not so much during this last pullback. So when the market corrects itself, we've got short and intermediate term rules to get us right back in. And that's what we do. And we detail it here every night on video, the most transparent advisor in the country. And if you're interested in becoming a client, reach out to us. Just makes common sense to participate when the winds are at your back and settle down when they're in your face. Because if you're a technician, you can, a competent technician, you can recognize that. And with that, I'm going to wrap it for the week, the month, and the quarter ending Friday, June 28th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great weekend.